Picture this. A president announces a ceasefire on his own social media app. The next morning, stocks explode higher. The S&P jumps 2.5%. The Nasdaq nearly 3%. The Dow rips over 1,000 points. Its best session in almost a year. Weeks later, the peace is already unraveling. And yet stocks are sitting at record highs. Every financial anchor on TV says the same thing. Relief rally. Investors are celebrating peace. Except that's not what happened. Not even close. What actually drove this rally has almost nothing to do with peace in the Middle East, and everything to do with how modern markets are wired to break. Let's take it apart, piece by piece. To understand the rally, you have to understand the panic that came before it. In late February, the US and Israel struck Iran. Iran's supreme leader was killed. In response, Iran moved to close the Strait of Hormuz, one of the most critical oil choke points on Earth. Over the following 5 weeks, the S&P had its worst losing streak in nearly 4 years, sliding almost 9%. But the scarier story wasn't on your screen. It was happening inside the trading desks of Wall Street. Hedge funds weren't just trimming positions. They were dumping risk at the fastest pace in 13 years. We know this because Goldman Sachs runs the prime brokerage desk that services most major hedge funds, giving them a direct window into what the smart money was doing. Their internal data showed the heaviest hedge fund selling in North America since the COVID crash of April 2020. Leverage across the industry was sitting north of 300%, near record highs, and short positions against major index funds like the S&P and Nasdaq trackers hit levels not seen since the pandemic. Commodity analysts were sounding actual alarms. One well-known oil strategist warned that if the Strait of Hormuz stayed shut, the world could need to erase 15 million barrels a day of demand, and that Brent crude could spike toward $250 to $300 a barrel. His word for the economic fallout wasn't recession, it was depression. That was the mood on Wall Street just 6 weeks before the so-called relief rally. Total, unanimous fear. Then, on the evening of April 7th, the ceasefire announcement dropped, and the next morning, it was as if someone flipped a switch. Over 400 stocks in the S&P closed green. More than a dozen hit all-time highs. Oil cratered. Brent fell around 13%. Crude oil future benchmarks dropped over 16% in a single session, one of the sharpest one-day drops since the 2020 crash. Here's the problem. The peace was barely real. A maritime intelligence firm that tracks global shipping using satellite and radar data found that traffic through the Strait of Hormuz was still down roughly 96% from normal levels. Only a handful of ships were moving through by midday, compared to well over 100 on a typical day. So if the war zone was still effectively frozen, what actually pushed stocks to record highs? The answer isn't peace, it's plumbing. This was a short squeeze, and a textbook one at that. Quick refresher. Shorting a stock means borrowing shares, selling them immediately, and betting the price falls so you can buy them back cheaper later and pocket the difference. But if the price rises instead, you're stuck. You still owe those borrowed shares, and now buying them back costs more than what you sold them for. As losses mount, brokers issue margin calls, demanding you either post more collateral or close the position immediately. When thousands of traders get squeezed at once, they all rush to buy back shares at the same time. That wave of buying pushes prices even higher, which triggers more margin calls, which forces more buying. That feedback loop is a short squeeze, and going into April 8th, with short bets at their highest level since 2020, the fuse was already lit. Here's where it gets bigger than just panicked traders. Once prices started climbing, the machines woke up. Enter CTAs, Commodity Trading Advisors. These are systematic funds that trade purely off price trends, with zero regard for headlines or geopolitics. Trend goes down, their models go short. Trend flips up, their models flip long. Automatically, Goldman Sachs estimated these systematic funds were sitting on roughly $30 billion in net short bets heading into the ceasefire. Once the S&P crossed key technical trigger points, their models didn't just close those shorts, they flipped aggressively bullish. Goldman initially projected these funds would need to buy back about $40 billion in stock. The real number ended up north of $86 billion across just 5 trading days, one of the fastest buying sprees on on record. Then came a third accelerant, the options market. When traders pile into call options, the banks and dealers on the other side of those trades have to hedge by buying the underlying stock to stay balanced. Analysts at a leading options tracking firm had flagged the market as sitting in what's called a negative gamma setup, a condition where dealer hedging amplifies price moves instead of dampening them. Prices rise, dealers are forced to buy more, prices rise further. It compounds on itself. A short squeeze, a systematic algorithmic flip, and forced options hedging. 3 dominoes falling in sequence. That's the real story behind the rally. Not peace, mechanics. And here's the part that should really change how you watch financial news. This isn't new. Rewind to December 2018. Markets were tanking on rate hike fears. Then the Fed chair said a single word, patient, on stage. And the Dow posted its largest single-day point gain in history at the time. Or August 2024, when the Bank of Japan raised rates for the first time in 17 years. The yen-carry trade unwound violently. Japan's stock market cratered 12% in a day, then bounced 10% the next. Different headlines, different countries, same underlying machinery.